Okay, we are recording. Hi there, everybody. I am doing this recorded lecture for chapter 6 of our textbook. This is the last chapter that we cover in Principles of Financial Accounting 1. And so in chapter 6, we're getting into a couple different things, but mainly it's focused around how we handle cash, right? What we consider cash. And so um just like it says in our book, and our chapter starts on page 239. So just like it says in our books, when we talk about cash, currency, coins, checks, money orders, traveler checks, bank drafts, or bank cashier's checks, right? So not just cash that's in the bank necessarily, but it can also include, as we're going to see, like petty cash funds or cash or change funds that are set up. And then we talk about also how to handle bank reconciliations, which deal with the bank cash account as it compares to the cash ledger account. So yeah, some fun things that we're covering here in chapter 6. And so I've got the PowerPoint pulled up. I'm going to share my screen with you, and then we'll go over this together. Okay, so chapter 6, again, we're dealing with mainly the cash account, right? We're talking about how we handle that cash account and kind of all things to do with that cash account. And we know, hopefully at this point, cash is one of our assets, right? And so just like it shows here, chapter 6, we're talking about bank accounts, we're talking about cash funds, we're talking about internal controls. So the chapter actually starts off with internal controls, and basically internal controls are procedures that are in place to protect our assets, right? And so we want to protect our assets against misuse or misappropriation, right? So we do not want misuse of assets. We do not want misappropriation of assets. So we've got those internal controls in place to help protect against misappropriation of assets. So that's kind of what we're talking about first. And there are different internal controls in place for different asset accounts, but again, this chapter mainly focuses on that cash account. So some of our learning objectives, again, we'll be looking at the internal controls for cash receipts and cash payments. Look at procedures for recording deposits and withdrawals, reconciling the bank statement, recording journal entries from the bank statement, and then doing the journal entries also associated with the petty cash fund and the change fund, which we'll talk about more as we go through the PowerPoint slides together. All right, so internal controls, again, policies and procedures designed to protect our assets, to help provide accurate accounting data, to promote efficient operation, to encourage adherence to management policies. Generally speaking, internal controls just help, help control the security of our assets, right? Like for example, an internal control that we talk about is like the separation of duties, and we're going to see that again as we continue through the PowerPoint slide through the chapter. But separation of duties, if we have several people involved in the process, that reduces the chances of fraud, because then more than one person would have to collude together or whatever, right? So that reduces the chances of fraud if more than one person is in control. And usually they say we want to have like an ARC to protect us. So ARC is the authorization of the asset, recording the asset, and then control of the asset. So generally those three things should be done separately or by separate individuals. And one of those individuals, like if we use, for example, a lockbox deposit system, one of those the recording, I guess you could say, or the recording would be done by the accountant, but the control of the asset is actually at the bank. Maybe a separate person that is able to sign off on the checks is someone different that's able to actually go to the bank and make a withdrawal, for example, right? So just separate people in different positions so that one person doesn't have full control of it, if that makes sense. So some of these internal controls for cash receipts that they talk about in your book, and again, this is page 239. Cash receipts maintain separation of duties between cash handling and cash recording. Designate someone other than the bookkeeper to open mail. Make a record of cash received. Endorse checks immediately upon receipt with the stamp for deposit only. Deposit cash daily. Journalize cash receipts as soon as possible, preferably by someone different from the person who first received the cash. And then post cash receipts to the accounts receivable accounts as soon as possible. So again, some of those internal controls for cash receipts. And then internal controls for cash payments. Make sure all cash payments are made by check with the exception of petty cash, which we're going to talk more about in this chapter. Make certain all checks are pre-numbered. Keep check supplies in a secure area. Assign someone different from the check signer to prepare the checks. Appoint someone other than the person preparing the checks to prepare the bank reconciliation. We actually talk again more about bank reconciliation in this chapter. And then keep petty cash under lock and limit access to one person other than the bookkeeper. So again, some of those internal controls. And so we see here kind of it dividing it up, or this little bit of a flow chart or illustration out of your book. Just like it shows here, internal control of cash is especially important because when there is fraud, it is usually involved with the cash account in some type of way. So from the cash receipts to the petty cash, maybe the money on hand or the cash on hand, to the payments, there should be a separation of duty so that there's not mishandling, misuse, or misappropriation of the asset, right? All right, so bank statements, one way that we control that cash account and stay on top of this is by doing monthly bank reconciliations. And so the reason why we have to do bank reconciliation is because when we think about our cash account, okay, we have our cash account at the bank. Let's say, for example, that we use Bank of America, right? So we have our cash account at Bank of America. And then whatever accounting software we use, let's say that we use QuickBooks accounting software. Whatever accounting software we use, we have our cash ledger account in our accounting software, right? That cash ledger account, that's the account that we've been getting practice with, doing our journal entries and preparing the financial statements and doing the T accounts. And right, we've been getting practice with that cash ledger account, right? So when you think about a business, we have our cash bank account, and then we have our cash ledger account, right? And in a perfect world, these two things would be exactly equal, but realistically, they're not equal because, and they will not equal. And the reason is, as we'll see as we continue to go through this, is because sometimes there's outstanding checks that we've written and they haven't cleared the bank yet. Sometimes there's deposits in transit, and so we've made the deposit, but it hasn't cleared our account yet as of the bank statement date. Or sometimes there's bank service charges, or sometimes, there might be a non-sufficient funds check. And so there's several things that can happen that would make our cash account in the bank different than our cash ledger account. So the point of bank reconciliation is to reconcile the bank statements, right? So when we, or reconcile the cash accounts rather. So when we think about the bank statement, again, that's prepared by the bank. Those are all of the debits and credits to our bank account, prepared by the bank from its viewpoint, right? All of the ins and outs of our bank account. And then we're going to see an example of this, but a legend of the symbols listed on the bottom of the bank statement. And we will see this on our example, but CM, credit memo, increases or credits to the account. Debit memo, decreases or debits to the account. Overdraft, withdraw of more, or withdraw of more than the cash balance in the account. So if we wrote a check for 1,000 and we only had 800 bucks in there, we'd be overdrawn 200 bucks, right? And then error correction of errors made by the bank. And you know, that error correction, we could also have that on our side, you know, where, you know, maybe the check cleared the bank for the correct amount, but we recorded it incorrectly in our ledger account. That's something we might have to deal with, right? So there's some things like that that come up. And then canceled checks are checks that we wrote to somebody in payment, or we wrote to a company in payment and it cleared our account. So that's a canceled check. It's cleared our account already. We wrote the check for payment of something and it cleared our bank account. So that's a canceled check. All right, so here's an example of the top half of the bank statement. And we're going to see the bottom half on the next slide. But on this one, it's showing us the debits to the account, which are decreases to the account. So remember, when we think about our cash ledger account, like if we use QuickBooks accounting software, this is our cash ledger account in our QuickBooks accounting software. Debits are increases to cash, credits are decreases to cash. But it is the opposite in a bank account, right? It's the opposite in a bank account, because when you think about it, a bank account, when we have money in the bank, that is a liability to the bank, because then they owe us that money, right? So then when we think about the bank cash account, it has opposite rules. Debits decrease it, because again, the cash that we have in the bank represents a liability to the bank. So debits decrease it, credits increase it. And so what we're seeing here are canceled checks, the checks that have cleared our account, the check numbers, the date they posted, the amount of the checks. And then it also says other debits. So debit memo, non-sufficient funds check from B.R. Rumson. So this was a check that a customer wrote us. It looks like for $283, and it came back non-sufficient, so it didn't clear. So they subtracted that from our bank account. And then here it says debit memo, automated teller. That's an ATM. So automated teller transaction. We withdrew $100, it looks like. And then debit memo service charge, bank service charge. So they decreased or subtracted our account $19.50. So it shows, you know, the total debits, right? The total subtractions. And then here it shows the total credits or additions, increases to our bank account. And so deposits that were made, the date the deposits were made, the amount of the deposit. And then other credits, credit memo for note collected. So we collected, the principal note was 1,000. That's the face value of the note or what the customers owed, plus $10 interest. So we collected, or the bank collected, a total $1,010 for us. Right? So that's what the bank statement looks like. And then again, we would take this bank statement and we would compare it to our accounting software, to our cash ledger account. And whatever the difference is in the balance, we have to reconcile the two. Okay, so again, that's what we're talking about here, bank reconciliation. That's what we have to do. Bank reconciliation uncovers the reasons for the difference between the two balances and corrects any errors that may have been made by the bank or by the business. Person performing the bank reconciliation will be making sure that the dollar amount of each canceled check matches the check entry in the ledger balance of the company's cash account. So again, comparing our Bank of America, cash account to our QuickBooks cash ledger accounting record, right? Comparing that dollar amount, that all of the charges, checks, and electronic transfers are correct, belong to the company, and deposits are made in a timely manner. So some of the things I know I've mentioned a couple of these already, but some of the definitions or verbiage that we'll be talking about in this process or when we're doing these bank reconciliations. Deposits in transit, deposits made after the bank statement was issued. Outstanding checks that have been written by the company but not yet received for payment by the time the bank sends out its statement. So again, we've written the check for payment, but it hasn't cleared the bank yet. Collections, money collected by the bank for the customer. Interest income, interest earned for keeping cash in the bank account. NSF check or non-sufficient funds check, deposited check that the bank cannot process because the check writer's account does not contain enough money. Service charge, bank charge for services rendered by the bank, and then errors, mistakes made by the customer or the bank. And again, I mentioned this earlier, it can be a bank error. It could be an error on our part, right? So we'll run into both of those situations and get practice with both of those. Okay, so kind of the steps that they talk about in reconciling the bank statement. Step one, cancel checks. So again, comparing the amount of each canceled check to the banks from the bank statement with the cash ledger. Comparing the deposits listed on the month's bank statement with deposits in the cash ledger. Figuring out which checks are outstanding. So the amount recorded on the bank statement with the amount recorded in the cash ledger, and then any other credit or debit memos that need to be recorded. And so here we see an example of a bank reconciliation. And, overall, the purpose of this or the goal of this is what these arrows are pointing to here. So it says when the reconciliation process is complete, the adjusted bank statement balance and the adjusted ledger balance of cash must equal. So we see here adjusted bank statement balance, 5,321, adjusted ledger balance of cash, 5,321. And then we can see how a few of these things are set up. For example, deposit in transit. So we start with the bank statement balance. First of all, we start with the bank statement balance, and then we add any deposits in transit, because a deposit in transit, what that means is that we have recorded the deposit in our cash ledger account, right? Remember, when we recorded this deposit in our cash ledger account, we would have debited cash, credited revenue, right? We recorded this deposit in our cash ledger account, but it hasn't cleared the bank yet. The money has not been deposited in the bank as of the bank statement day. In this case, March 31st, right? So we recorded the deposit, but we didn't get it in there fast enough for the March 31st cutoff, right? So we have to add that to the bank statement balance. And then these outstanding checks, again, outstanding checks, we wrote the checks. We have written the checks for payment, but they have not cleared the bank, right? So we wrote the check, we mailed it to whoever we owed. Maybe we mailed it to, our car lender, car loan company, or maybe we mailed it to one of our vendors or one of our suppliers or whatever, right? We mailed the check, but it hasn't cleared our account yet. So we would have already recorded it in our cash ledger account in our accounting software. when we wrote those checks, we would have, debited accounts payable, credited cash, right? When we wrote those checks. But they haven't cleared the bank account yet. So they've been recorded in our cash ledger account, but they haven't been recorded in the bank statement. They haven't cleared the bank. So we have to subtract those from the bank balance. And then down here looking, those are the only adjustments, the deposit in transit, the outstanding checks that arrive, that gets us to that adjusted bank statement balance. And then the ledger balance of cash, a couple things that were on the bank statement that were not recorded in our ledger. We have this note collection. So this would have been added to our bank statement balance already, but we have to record it in our cash ledger account. A note collected by the bank would be a debit to cash, credit to accounts receivable, right? Or notes receivable. And then here, we're deducting bank service and collection charges of $29. So again, this $29 would have already been subtracted from our bank account. We need to subtract it from our cash ledger account. So this would be, to record this, we would debit, say, bank service fee expense or whatever, right? Bank service charge expense, credit cash type thing. And again, once we make these adjustments, the point is that the adjusted bank statement balance and the adjusted ledger balance in cash equal, right? All right, here we see another example. And again, this is another example in your book. I'm going to try to make this a little bit bigger for us. This is another example out of your book. So this one, again, we see the bank statement balance. We start with that bank statement balance. We add deposit in transit because, again, deposit in transit, we'd already recorded in our cash ledger account, but it didn't make the bank in time before this statement was prepared, right? So we've got to add that in. Outstanding checks, we have to subtract these because, again, we've already subtracted them from our cash ledger account. We need to subtract them from the bank account. We've already written them and subtracted them from our cash ledger account, but they haven't cleared the bank yet. We haven't subtracted them from our bank account yet, right? So we have to subtract them. That gets us to the adjusted bank statement balance. And then in this case, the adjustments that had to be made to the ledger balance, again, this would be in our accounting software if we use QuickBooks. There was a note collected by the bank. And then also there was an error in recording check number 2002 payable to Sanders Inc. So it looks like we recorded it as 745, but we should have recorded it as 754 because we're adding $9 more. So we would have recorded it for 745. We should have recorded it for 754. We transposed the numbers. We transposed the 5 and the 4. And then deductions, bank service charge and collection charges. And then we had this NSF check that we have to subtract, and then cash withdraw that has to be subtracted. So all of those would require, journal entries or entries to record them. So note collection would be like a debit to cash, credit to notes receivable, or we'd have that interest revenue too. So we would debit cash for 1,010. We would credit notes receivable for 1,000, credit interest revenue for 10. Error in recording check number 2002 payable to Sanders Inc. So probably when we wrote this check, since it was a check in payment to Sanders Inc. Probably when we wrote this check, it would have been like a debit to accounts payable for Sanders, a credit to cash, right? So then we need to do another $9. So it's going to be, I would think, a debit to accounts payable Sanders. Or no, excuse me. We're adding it to our ledger balance. Error in recording check. Yeah, that one's interesting. I don't know. I'd have to look at it and read the wording on it or go back to the exact example in the textbook. But we'd be adding to our ledger balance. So we'd be debiting cash, crediting. I don't know. And then deductions, bank service charges. This would be like a debit to the bank service expense, or bank charge expense, credit to cash. NSF check, we would debit accounts receivable for Rumson, credit cash. So we'd create that accounts receivable again. And then cash withdrawal by Melinda B. Rowland. This is a debit, owner withdraws credit cash. And so now I'm just curious, since we're looking at that, what that, and I didn't realize that I was going to be thinking about what the heck was going on here. Let's see. If they show it to us in the book. I don't know if they show it to us in the book for that one or not. Let's see. Yeah, so for that one, they show us a debit to cash, a credit to accounts payable. A debit to cash, a credit to accounts payable for that $9 payable to Sanders. Okay. All right. Okay, petty cash fund. So that's the next thing that this chapter talks about, which, I really, these petty cash fund entries are important. This is also something that gets reconciled on a monthly basis, usually, especially if you're a company that closes your books out every month. But, the most important thing to me, I think, in this chapter is really the bank reconciliation. And that's probably kind of what we'll spend the most time on. But we'll at least get a little practice with the petty cash fund entries. And so establishing the petty cash fund. Petty cash is just a certain amount of cash that we keep on hand in our office to use for like small office expenses usually. So in this case, they're establishing a petty cash fund of $100. At the company I worked for, our petty cash fund was $300, and we would pay any like small cash expenses up to $50 out of petty cash. Over $50, the person had to put in a check request for it, but we would pay expenses up to $50 out of ours. But just like it shows here, the maximum amount that a business keeps for petty or small items, payments that exceed this amount must be processed by regular check through the journal. Rowland's Delivery Services decides to establish a petty cash fund of $100. So, we're basically taking $100 out of the bank, if you will, and putting it in a lockbox that we're going to keep in our office to use for small items, right? So to establish this fund, we're debiting petty cash fund, crediting cash. So we're just moving it from one cash account to another ledger account, essentially, right? All right. And so the petty cash payments records. And so, again, as we go through the month, we establish this petty cash fund. And you can think about it like a little lockbox that we keep some cash in, because that's exactly what it is. And so we establish this petty cash fund. And then throughout the month, different employees and individuals come and present receipts or whatever to get paid out of the petty cash fund, right? So There's generally a receipt or a voucher that is given each time there's a petty cash payment. And then at the end of the month, we would list all the expenditures in their entirety and what type of expenditures they are. So eventually those expenditures have to get recorded in their proper expense accounts, right? So this petty cash payment record, which it shows us on the next slide, says that it lists the petty cash vouchers and the accounts that are to be charged. Again, the expense accounts. The purpose of the expenditure, maybe, or a brief explanation may also be listed. And then it says special columns for frequent types of expenditures are included in the distribution of payments section. All right, so we see that example of the petty cash record and all of the various payments. So we made a $10 payment out of petty cash to Mason Delivery Squad, $10. That's going to go under miscellaneous expense. And then we also, looks like, took cash out and bought some pencils and pens for $8.59. That goes under the office supplies account. We bought local newspapers for $2.50. Those go under miscellaneous expense. Postage on incoming packages, $3.70, miscellaneous expense. Withdrawal by MB Roland. So that would go under owner withdraws. And so that's just under this other accounts deal. Stick on tabs, office supplies. Gift for retiring employee, miscellaneous. Postage for mailing, miscellaneous. You know, again, you get the picture. The payment record just shows all the things that were paid out of petty cash. And so when we get to the end of the month, remember we started with $100 in the account. We get to the end of the month, we only have $6.71 left. And so we need to write a check or reimburse this fund for $93.29 to get it back up to 100 is what that's telling us. All right, so when we record these petty cash entries, we record them into those accounts listed from the petty cash voucher. So, or petty cash disbursements record. So office supplies, miscellaneous or maintenance expense, miscellaneous expense, owner withdraw, and then we credit cash for the entire amount that we have to reimburse that fund, right? All of those expenses that we paid, or those items that we purchased, you know, add up to the amount that, you know, was spent in total from petty cash, and that has to be reimbursed to petty cash. All right, so similarly, a change fund could also be established and is also established when the business has a large amount of daily cash receipts, right? So if we think about like a grocery store, when you go to the grocery store, you can pay cash, and the lady at the grocery store register, you know, the drawer pops open and she gives you change out of it, right? That's the change fund, right? So they start with X amount in their drawer every day. Let's say they have, you know, in this case, what it's showing us on the PowerPoint slide, let's say they have $150 change fund. That's the amount that they're going to keep in their drawer every day. And that's how they're going to make change to customers out of the different transactions that happen throughout the day. So it says a change fund is debited only when it is established. The change fund account, just like the petty cash account, is an asset. It is recorded in the balance sheet immediately below cash unless petty cash fund account is larger than the change fund account. In that case, it would be cash, petty cash, change fund, right? And so we see here the debit to the change fund, the credit to cash. This is to establish that change fund. And then every day, we would basically record our daily receipts. and determine how much can be deposited into the bank account. So for example, we get to the end of the day, we have a total cash count for the day of 1,575 minus, we want to keep 150 in our drawer. So then we're going to deposit 1,425. And again, that deposit, we would make that deposit in the bank. We would record it in our accounting software. Let's say we use QuickBooks. We would record it in our accounting software as a debit to cash, a credit to revenue, and in this case, income from services. And then we would deposit that money into our Bank of America bank account, right? Is how that would work, how that would look. All right, cash short and over. Cash short and over. So again, if we are a company that brings in a large amounts of, or has several cash transactions throughout the day, a grocery store or a 7-Eleven or something like that, right? We've got a lot of cash transactions during the day. There is the potential to have a cash shortage or a cash overage, right? So as the terms imply, a shortage means that, we do not have enough cash in there, right? Maybe it says that we have cash receipts of 1,000 and we only have 998. Then we have a $2 shortage, right? So there can be a shortage. There could also be an overage. So, using the same example and to make the math easy on me, if our sales are 1,000 for the day, but we have, 1,002 in there, right? Then we have a $2 overage. And so what we do is we kind of keep a running total in this account until the end of the fiscal period, or, it might be something we might want to adjust every month if we wanted to. And maybe it would be depending on how the amount in there. If it's a low amount, $2 or $3 or $4 or something like that, we might wait a whole year before we make an adjustment. But just like we're going to see in this example, a cash shortage becomes an expense, miscellaneous expense. Cash overage becomes miscellaneous revenue, miscellaneous income. All right, so here's our example. It says on September 14th, Roland's delivery service has a cash count of 1,663, while the cash register tape totals 1,515. And there's supposed to be $150 in the change fund. So if the register tape shows 1,515, plus we had 150 in there to start, so 150, then we should have $1,665. But we only have a cash count of 1,663. Again, if we say, okay, our cash register tape, our sales for the day were 1,515, plus we started the day with 150, technically we should have $1,665 in cash. We only have 1,663. So again, we have a cash shortage, a $2 shortage, right? And so the entry to record this, we would debit cash, short and over, we would credit revenue, income from services. The example of the cash overage, it says on September 15th, Roland's delivery service has a cash count of 1,732, while the cash register tape totals 1,578. So again, sales for the day, cash register tape totals 1,578, plus we started the day with 150. That means that we should have $1,728 cash in our register. We actually, right, we should have 1,728. We actually have 1,732. So we're over $4. So then when we're over $4, then we're debiting cash for the total amount of cash, 1,582, We are crediting revenue for 1578, crediting cash short and over. So if you think about it, you know, in the last example, we had, you know, $2 debit to cash short and over. We were short $2. Now we're over $4. So now we're at what? We're over $2 overall if we're thinking about the balance in that account. All right, and here's the journal entry to record those. Again, we talked about them based on those T accounts that we looked at on the previous slide, but this shows you exactly what those journal entries would look like. All right. The main thing is, remember, when it's short, it's like an expense. When the cash is short, we debit it just like an expense. That's in fact what it becomes. When we eventually close this account out at the end of the calendar year, the end of the fiscal period, whatever, if this is overall short, then we're going to call it miscellaneous expense. If we're crediting cash short and over, that means we're over. We have more, you know, more, we're basically charging it to a revenue, or we're recording it as a revenue is what it becomes. So it gets credited when it's over. Okay, you know, just like it says here, and I've said this a couple times already, at the end of the fiscal period, if the account has a debit balance or a net shortage, it is classified as an expense, usually miscellaneous expense. If an account has a credit balance or a net overage, it's classified as a revenue account, probably miscellaneous revenue or miscellaneous income. All right, here's some of the exercises we're going to be looking at when we work on this chapter together in class. As always, let me stop sharing this PowerPoint. Uh-oh, what am I doing here? Hi there, guys. Okay, so as always, once you have a chance to view this recorded lecture and hopefully read your chapter and we get some practice with it, let me know if you have any questions. I look forward to seeing you guys soon. Bye-bye.